Topic introduces country risk as the possibility that economic, political, social, or financial conditions within a country may adversely affect the value of investments or the ability of borrowers to meet obligations. Country risk is particularly important in international lending, trade finance, and cross-border investments because events within a sovereign nation can influence both public and private sector repayment capacity. Financial institutions and multinational corporations face country risk when dealing with foreign governments, corporations, or financial institutions. Factors such as political instability, weak economic growth, inflation, exchange rate volatility, and regulatory uncertainty can significantly increase the likelihood of financial losses and reduce investor confidence. The topic further explains that country risk consists of several interconnected components, including political risk, economic risk, transfer risk, and legal risk. Political risk arises from government instability, policy changes, expropriation, or civil unrest that disrupt economic activity or contractual obligations. Economic risk reflects macroeconomic weaknesses such as high inflation, fiscal deficits, excessive debt, and declining foreign reserves. Transfer risk occurs when governments impose currency controls or restrictions that prevent borrowers from converting local currency into foreign currency for debt repayment. Legal and regulatory risks involve weak legal systems, inconsistent enforcement of contracts, or sudden regulatory changes. Together, these factors influence international lending decisions and investment strategies. A key concept is the assessment and measurement of country risk. Financial institutions use both qualitative and quantitative approaches to evaluate a country's economic stability and repayment capacity. Analysts examine indicators such as gross domestic product growth, debt-to-GDP ratios, inflation rates, fiscal balances, political stability, and foreign exchange reserves. Credit rating agencies also assign sovereign ratings reflecting the perceived creditworthiness of governments and their ability to meet debt obligations. Scenario analysis and stress testing help institutions evaluate how adverse economic or political events could affect exposures. Effective country risk assessment supports prudent portfolio diversification and reduces vulnerability to international financial crises. Topic also focuses specifically on sovereign default risk, which refers to the possibility that a government will fail to meet its debt repayment obligations fully or on time. Sovereign default can occur on external debt denominated in foreign currency or domestic debt issued in local currency. Governments may default due to fiscal imbalances, declining revenues, economic recessions, political instability, or excessive debt burdens. Sovereign defaults can have severe consequences for financial markets because government debt is widely held by banks, pension funds, insurance companies, and international investors. A default often leads to currency depreciation, capital outflows, reduced market access, and broader economic instability within the affected country. The topic also discusses the factors influencing sovereign default probability and the methods used to manage sovereign risk exposures. Debt sustainability analysis evaluates whether governments can generate sufficient revenues and economic growth to service debt obligations over time. External vulnerabilities, including reliance on foreign capital, trade imbalances, and declining export revenues, increase default risk significantly. Investors monitor sovereign bond spreads, credit default swap prices, and rating agency outlooks to assess changing perceptions of sovereign credit quality. Financial institutions manage sovereign risk through diversification, exposure limits, hedging strategies, and stress testing. International organizations such as the International Monetary Fund often play critical roles in supporting countries facing severe financial distress. Finally, topics emphasize the importance of understanding country and sovereign risks within global credit risk management frameworks. International financial markets are highly interconnected, meaning sovereign crises can quickly spread across borders and affect global financial stability. Historical sovereign debt crises have demonstrated how economic mismanagement, political instability, and excessive borrowing can trigger widespread market disruptions. Financial institutions must therefore continuously monitor geopolitical developments, macroeconomic conditions, and fiscal sustainability when managing international exposures. Strong country risk analysis and sovereign risk assessment support more informed lending decisions, improve portfolio resilience, and help institutions reduce losses associated with adverse political and economic developments in global markets.